Hi, a very good afternoon to everyone, and I welcome you all to the first webinar for the year 2023. And before starting, just a happy new year to everyone who has attended this session. And so, just to introduce you about Fintu. So, Fintu is a wealth management firm. We are based out in Mumbai. We cater to the end-to-end financial needs of our clients, whether it be financial planning, money management, wealth planning, tax planning, estate planning, or will planning. We have provided services to over 1 lakh plus clients, not only in India, but also abroad. And the speaker for the day is Miss Nidhi Manchanda, who is a CFP, and she has a decade of experience in teaching, coaching, mentoring, working professionals with their personal finance and investments. So today's topic will be all about investment strategies for 2023. So as we have all know that the last year was a roller coaster ride when it comes to investments, and a lot was happening around the world, whether it be Russia-Ukraine war, high inflation, hike in the interest rates. So there is a need to strategically plan your year ahead. That is why this webinar has been planned for you. So without wasting much time, our speaker will start the session for you all. Over to you, Nidhi.
Thank you, Nawaz. And a very good afternoon, everyone, in today's session. So I hope everyone will, is able to hear me properly. If not, you can just let me know, or Nawaz, you can just confirm if the audio is proper.
Yes, it's perfect. You can just share your screen once.
Yeah, I'll just share my screen. 1 second. Yeah. Is it visible?
Yes.
Great. Okay, so like all of you are already aware that in today's session, we'll be discussing about what are the investment strategies that you can take in this year 2023. And we have seen how the year 2022 has been. We have seen that interest rates has been rising to control the higher inflation, and how the stock market has performed. And for 2023 specifically, what should be your investment strategy is what we'll be discussing in today's session. I just encourage each one of you, if you have any questions, any queries related to your finances, anything that comes to your mind that you would like more clarity on, feel free to put your questions in the Q&A box. Don't put your questions in the chat. If some interaction is required, we can do it in the chat. But if there's specific questions, I would just ask you to put that question in the Q&A, so that towards the end of the session, I can take up questions from there, and we can discuss there itself towards the end. I hope that's okay with everyone here with this flow. And okay, so I think everyone is able to see the screen. Everything is fine. Okay, if anyone is not able to see the screen, I would suggest you can log out and log in again, because it is visible. The screen is already there. Maybe because of the internet issue at your end, you might be having certain issues. So you can log out and log in again, and you'll be able to see the screen, and check your net connection as well. Okay, so with this, I think we can start the session. So effective strategies to build wealth in 2023. Now, let's start with what is expected in the year 2023 when we talk about, India as an investment. Now, we have seen, and we know that globally the things are not going in the right direction, and there is expected recession that is being expected. That recession will come overall, globally if we talk about. But compared to if we talk about India specifically, it has been estimated that India's growth in the year 2023 will be somewhere around 6.5, 6.6%. So we can say that India will not have that much of effect of the recession as such, and that is why it is an opportunity for you to invest in the markets, and in India specifically, in the companies of India. So here are some pure points. If you talk about in positive outlook for India, here is when we talk about Sensex, Nifty, they're reaching the all-time highs. Indian markets have also performed despite global headwinds like Russia, Ukraine, geopolitical tensions that we have seen, higher inflation, and then rising interest rates to control that inflation as well. If you talk about domestic imports, that have shown tremendous participation in fueling the Indian economy. And talking about investments, specifically mutual fund investments and SIPs, currently we have 6 crores SIP accounts and monthly flow of more than 13,000 crores. Cumulative SIP AUM is around 6,86,000 crore as well. So we can see that more and more people are investing their money regular with their investments, and that is what helps the economy to grow and boost the investment sentiments as well. If you talk about the valuation, India has been, somewhere around 40% premium valuation compared to its peers, but currently it's on a very higher valuation, close to 80%. And markets at lower levels will be supported here by both the domestic and the global flows. At higher level, there will be increased supply in IPO and strategic investors like private equities. So this could be one thing to look forward to. From sentiment point of view, OPEC and Fed actions, Russia-Ukraine war, and there are certain things that we can look out for. China COVID policy, it may impact the market and supply chain demand. So there are a couple of things. 6 of the world's top growing cities in 2022 were in India itself, and India is set for capital utilization and increase economic activities. So basically, the main agenda here is to understand that, yes, from investment point of view, you can definitely look out for investment in India. Globally, the things might not look that great, and there is a fear of recession. We have seen tech companies, laying off employees, and there has been a slow in growth rate. In this year, 2023, that is what is being expected. India will have certain effect on that ground, but as per the reports, expectations, if we see of the major analysts, it will not be that much as compared to the entire world or globally, if we see. So like I said, 6.6% is what is expected to be the growth in the year 2023 for India, which is very positive. Now, talking about investment strategies, how you should be framing your own investment strategy, where you should be investing your money in this year, what should be your plan, what should be your financial plan, how you should be, reviewing it, what should be the key factors that you should be checking throughout the year while reviewing your investment plan. That is what we'll be discussing now. Now, before I start directly into the strategy part of it, I would like to understand from all of you that whenever you're making an investment, what is the sole purpose for you to invest your money? Why do you invest your money? Can you give me some answers in the chat? What do you look forward to when you're investing your money? So chat is open, you can just mention. So when you're investing your money, whenever you're making a decision that, yes, this is an investment opportunity here, I would like to invest. So on what basis do you make that decision? What are you looking forward to? What is the reason, the primary reason for you to invest? Okay, someone is saying good returns. Okay, yes, Yugal, good returns, you would want your money to grow, and that is the reason you would want to invest your money. That's right. For wealth creation, retirement planning, child education, secure future, yes, these could be the reason, Anirban. Nilesh is saying after retirement, short-term money, okay. Yugal is saying more than inflation or fixed deposit. So your main agenda is when you're investing your money, you should be earning more than inflation. You are able to beat inflation, fixed deposit. That's correct. Income, money to become wealthy, to get profitable returns, build a corpus for retirement, to maintain, manage, and same lifestyle impacted due to market, retirement, personal milestones. That's great, Sandeep. Capital growth, capital protection. Okay, so there could be a couple of reasons why you would be making your investment. Now, one of the person mentioned about inflation, and that's a very crucial reason why you would be investing your money, or why you should be investing your money, is to beat inflation. That is really important. Now, if we say that, as per the past data, and we see how the inflation, currently the inflation is on a higher level, although it has been a little down, but again, a higher inflation. On an average, if you talk about around 6 to 7% of inflation, then we have to make our investment in such a way that we're able to beat inflation. If you're not investing our money beating inflation, then the real value of our money is actually going down, and we will not be able to create wealth for future requirements and needs. So that's really important, that you need to invest for beating inflation. The second thing is also important to know is taxation. Whenever we are earning income, a major part of our income goes towards paying taxes. So whatever we are earning is not your in hand. So once the taxes are gone, then you are left with one part of it only. And then because of the inflation effect, the real value of your money is actually going down. I would say these are the biggest enemies when you are trying to invest money, trying to grow your wealth. These two factors try that your money doesn't grow to that much level. So you have to make sure that whenever you're making an investment strategy, you are keeping inflation in mind, that yes, I have to beat inflation overall as a portfolio, not each of the investments. And also all your investments are tax efficient as well. So one needs to keep these two things in mind while making any investment strategy for themselves. Moving ahead, when we talk about investment strategy, the most important thing that you should be doing is to have financial goals. Now, most of the times you must have realized that investment decisions usually are taken by considering that, my friend has invested here and he has got good returns, or some relatives have invested their money in real estate and they're getting good returns, I should also be doing it. So you basically try to replicate it, which is not a wise decision to do. Every individual is different, every individual's risk appetite is different, every individual's requirements are different, every individual is investing for a different investment horizon. So it's really important that you have your own financial plan with you. And the very first thing that you need to do is to define your financial goals. Whenever you're investing your money, you should know that when do you need this money, for what purpose you are investing this. Is it very crucial? Is it something which is like a luxury, or is it after 1 year, or is it after 5 years? What your exact financial goal could be. So can all of you tell me in the chat what kind of financial goals you are looking forward to for your investments? What is that you want to achieve in future? What is that everyone would want to grow wealth, but why do you need that wealth? What are your financial goals that you want to achieve with the money that you would want to create? What are your financial goals? Anyone can mention in the chat, or a few of you can mention what are your financial goals. We are talking about here, as you can see the heading, we are saying smart financial goals. So goal need to be very smart. I'll just explain what smart means. But yes, some of the goals. Okay, so Pallavi is saying house or flats. Anirban is saying retirement, child education. Pallavi is saying buying house after retirement also. Okay, Shivram is saying child marriage, retirement. Nilesh is saying second income after 40. That's great. Dinesh is saying retirement. Sandeep is saying have at least 5 crores in my corpus for self and family, get free of any loans. That's great goal. Future education, travel, and emergency corpus. That's great, Nitya. So basically, these are your financial goals. Now let's understand, why I'm saying these needs to be smart. So I understand these are your financial goals, which is good, but it has to be a smart goal. Now, what a smart goal is, that it has to be very, very specific. Like most of you have mentioned very specific things like retirement or child education or vacation or emergency corpus, liquidity, or income after, you second source of income that you would want to generate after 40. So very specific goals. So it has to be specific. It should not be I want to be rich, I want to create more money, I want to have just more money and more wealth. So these are very vague things to have very specific thing that you want to achieve. Second, the goal should be measurable. One or two, a few of you just mentioned the amount against your goal, that you would need 5 crores, you would need this much XYZ amount. So it has to be measurable. It should not be open. So have some amount attached to your goal, that how much you need. That's for specific goal. How much amount do you need? It has to be measurable. It should be attainable and realistic as well. It should not be that you're aiming for a too big amount in a very less period of time. So make sure that it is attainable, it is realistic. You can always get in touch with a financial planner to understand how to create your own goals which are attainable and realistic for you. And the last one is time bound as well. Don't just say that I want to buy a house. You have to have some timeline, that you want it in 2 years, 3 years, 4 years, or you would want a financial advisor to guide you on when will it be possible for you to have a house. So always define a goal having these criteria. It has to be smart, specific, measurable, attainable, realistic, and time bound. This is how a financial goal should be. So this year 2023 has started. Make sure that you sit with your family members, whoever are the decision makers. So husband and wife can sit together, or maybe you can sit with your parents and define what all things that you want to achieve in future for this year, as well as for some upcoming years as well. Make a list of all the goals. Now once you have this list, what you need to do is you need to create a strategy again. So first thing is, you have identified smart financial goals. That step is already being done. Now the next thing will be categorization goals into buckets. So you need to know, let's say if you have 5 goals or 6 goals, how many are short term, how many are medium term, how many are long term. That is something which you need to find out. You need to just bifurcate it and say that I have 1 or 2 goals which are short term, and let's say 1 goal which is medium term, and there are 2 goals which are long term as well. So based on that, you bifurcate. Now to define it, you might have questions. What do you mean by short term, medium term, and long term? So short term could be any goal which is within a period of 3 years, will be considered as a short term goal. 3 to 5 years is something which is medium term, and anything which is more than 5 years away will be considered as a long-term goal. Now, why this is important is because your investment strategy will be different for a short-term goal and different for a long-term goal. So if I talk about short-term, you should not be investing your money into equity markets to achieve those short-term goals. But on the other hand, if we talk about long-term goals, definitely equity exposure is required so that you are able to beat inflation in the long term, and overall your portfolio get a boost and your wealth creates. So for that purpose, that is required. So it's very important that once you have a list of your goals, you divide it in short term, medium term, and long term for yourself. So this is what we are discussing about, a strategy that you need to do this year for 2023, how you will be defining your goals. Next is asset allocation. I'll discuss this in detail. When we talk about investments, it's not just that whichever investment is giving me higher returns, I'll just, invest all my money there, because, based on past returns, I feel this is something which is best asset class. Be it, share market or equity, or be it debt, or be it, bonds or gold or real estate, or maybe, liquid funds. So you should not be investing everything into one particular asset class. There has to be some diversification that needs to be done. That is what we'll discuss. Now, after that, selection of the right investment. So once you know that, let's say 60% I should be investing into equity, 40% I should be investing into debt, then in that 60% of equity, where should I invest? What all stocks I should be investing into, or what all mutual funds I should be investing into, which all categories I should have some exposure. That is the next step that you would be taking, and that is selection of the right investment. And then the process doesn't stop here. Make sure that in the entire financial year, the calendar year, financial year, you review your financial plan as well on a quarterly basis for investments. But other than that, once in a year, you can review for your major goals and everything. But if for investment, equity investment specifically, on a quarterly basis, you can have a review and check that whether, all your investments are going in the right direction. Is there any laggards? Is there any investment which is not performing that great? Is there a need to change the investment based on the economic outlook as well? Is there a need to switch from equity to debt? That is something you should take a call. Okay, so this is something which you need to do. So I just repeat: identification of your SMART goals. Then you categorize into short term, medium term, and long term. Then define an asset allocation strategy for yourself. Select the right investments within each asset class, and then review your investment portfolio. So this is something which you need to do. Now, talking about asset allocation, we will talk about different investments. Now, people, who have joined the session, where all you have invested your money? Can you give me some investment options? Where all you have invested? It could be any one particular investment, or you must have invested into multiple investments. So I'll also get an idea that where all you have invested, whether you are diversifying your money, or you're just investing into one particular investment, one particular fund, or one particular asset class. So just mention in the chat where all you are investing right now. Okay, so Public Provident Fund, mutual fund, Pallavi, that's great. Nilesh is investing into mutual funds. Suraj is investing into equity. Nilesh, gold. Stocks, mutual funds, Mayank, okay. Bonds and mutual funds and equity, Rashmikant, okay. Real estate, okay. Payal is investing into endowment policies, fixed deposits. Poonam into fixed deposits and for emergency fund. Sharmila is investing into equity, fixed income, mutual funds. Okay, so some of you are just investing into one or two investment options, and some of you have mentioned about multiple options as well, like real estate, FD, bonds, equity, mutual funds, NPS. Okay, that's great. Gold investment, VPF, that's great. So basically, when we talk about our investment, there has to be a diversification. You need to invest your money into different asset classes. Now, when we talk about this, there are certain model asset classes I will show you. Now, this is not something which I am recommending right now, but this is just to get an idea that based on your risk profile or the age group, it is how your asset allocation should look like, but it can definitely differ from person to person depending upon a person's requirements, needs, long-term, short-term goals. It may differ. Generally speaking, if we say if a person is very highly aggressive, equity exposure should be high. So as high as 80% could be into equity. Another 15% can be in debt, and 5% could be in gold investment. And if someone is aggressive in the age group of 36 to 45 and aggressive, then 70% in equity, 25% could be in debt or bond investment, and 10% exposure to gold. Then comes your moderate risk profile. Here again, your equity exposure will be reduced to 60% and 30% in debt, 10% in gold. So gold exposure should be just 5 to 10% of your entire portfolio, whatever be your risk profile. So that is the only amount that is required for hedging purposes, so that your investments which are there in equity or debt, use gold as an investment and use it more as a portfolio diversifier for yourself. Then if you're very conservative, then you should be investing more into debt, and equity exposure should be less. So here in this case, 20% in equity, but 70% in debt, and 10% again gold. And if you're highly conservative, then it should be 80% in debt investments only. But again, understand, when we talk about conservative or highly conservative, where more exposure is into debt and lower exposure into equity. But if you have more goals which are long term, if you have 5 years, 10 years, 15 years down the line for, let's say, your retirement goal or any other, maybe child's education goal, and even if you're conservative, I would suggest that try to understand, equity asset class and have certain, additional exposure to equity asset class, because again, this is the asset class which will actually help you to grow your wealth for long-term goals, at least, even if you're a conservative investor. So that much of awareness should be there. Understand how the asset class works and try to increase the exposure there itself. Okay, so this is some idea that this is how your asset allocation can look like. Now, to understand why it is important that you do an asset allocation, why it is important that you diversify your money and you should not be investing everything into one particular investment category. Now, if you see this chart specifically, here you can see there are different years which are given. Now, if you talk about the first one, 2013, in the year 2013, international asset class has given 45% return. But the next year, the small cap category has been outperforming. Then credit risk. And then again, if you see just the last year, 2022, gold has been outperforming. So gold was the outperformer, giving 11.3%. Considering credit risk funds around 5.2%, large cap around 2.7%, mid cap and small caps has given negative returns, has given not very good returns there. But what you can notice here is that no particular asset class will be an outperformer throughout. So if we talk about a small cap fund, which is giving 62.9% return, it has given in the year 2014. Then the next year, the returns were 6.1%, then again 59%. So you can see some volatility that is happening in different investment options. Similarly, if you talk about gold, gold has been not always been performing, but there is a journey there. We can see, starting with negative 18% to 2.2, negative 7.9%. And then current year, if we see, in the last few years, gold has been one of the outperformers compared to the other investment options. So whatever example that you take up from this particular chart, you will see that, sometimes one asset class is performing than the other. So it's very important that you diversify your investment into different asset classes so that it has a good balance of how your portfolio will actually grow with decent returns. So in order to find out that I will be investing only in that particular asset class, in that particular investment option, which will be giving the higher returns, there are higher chances that you might lose the opportunity. Also, if you are investing looking at an asset class, looking at the past returns, sometimes, it will not work in your favor. So again, from this chart only, if you take up an example of small cap into 2021, it has given return of 62.8%. Looking at past returns, you might feel that, this is the category where I would like to invest the entire money that I have. You will see the next year itself, it was down to negative 7.5%. So it's very important that, yes, in order to have good returns, decent returns on your portfolio, around 15 to 18% on an average, it is important that you diversify into different asset classes. But yes, the ratio that you decide, it could be, if you're an aggressive investor, you could invest more into mid caps and small caps and lesser into gold or large caps and debt investment. If you're a conservative investor, you invest more into debt options and less into equity. But again, the balance is required. Too much exposure to one particular investment is something which is not suggested. Right? I hope this part is clear till here, that it's really important that you need to diversify your investments. If any questions so far, feel free to park your questions in the Q&A. I'll definitely take it up from there. I can already see there are a few questions, but let me just complete a few of the more slides and then we'll just move on to the Q&A itself. Okay, now till now we have discussed that It's really important that you should be having a goal in place, financial goals. Goals should be smart. Then there is a strategy that will be following. You should be maintaining a proper asset allocation. Then you'll be talking about investments. And it's really important to understand about review and rebalancing strategies as well. Now, when we talk about review, what happens? This you can also do for the year 2022. The entire year gone by, then you can see how your entire funds have performed. So review the performance of your investments. You should be understanding which of the investments have outperformed for you, which of the investments have not performed that well as per the expectations. Is there any investment which is underperforming consistently for last 3 to 4 years? Then it is time to change or switch. Those are kind of decision needs to be taken when you're reviewing your financial plan. Review your goals. You have to review your goals. It happens that we create a goal for ourselves, but it need not remain the same throughout. With the increase in the standard of living, you might increase your retirement corpus goal. There could be an additional goal of a house, maybe if it was not there earlier, or it could be an increased goal of having a car, or maybe something that you would wanted now you don't want it any longer, and that goal you can remove as well. If you're someone who is just starting out with a family, then maybe some children's education goal would add up. So just review your goals from time to time and understand whether you are on the right track or not. You can review your income. So as your income is increasing, make sure that you are increasing your investments and savings as well. Don't just let the increased or the hike part go into additional expenses rather than savings. So whatever is your hike, whatever percentage your income is growing, make sure the same percentage of savings and investment is also growing. So you are at par for your future goals, and making sure that all your long-term goals and medium-term goals you are able to achieve by doing this strategy. Expenses also, again, depending upon your family situation, sometimes your expenses could be higher, sometimes it could be lower. On an average, understand where your money is going. You should have a complete understanding of what my mandatory expenses are, what my wishful expenses are, what are the expenses which can be avoided in an emergency situation, and what are the expenses which will be there even if there's no source of income. I have to do these expenses. So it's very important that you have that kind of an understanding on your cash flow. That is important. Keep on reviewing it. And if you feel that too much money is being spent on luxuries, on just wishful expenses, try to curb it and try to increase your savings. Ideally, 30% of your in-hand income is something which you should be saving for your future goals. If your goals are bigger, you might have to do a little higher savings, but don't go below 30%. If more you can do it, well and good, but at least make sure 30% of your in-hand income you are able to save. So at any point of time you feel that this ratio you are not able to maintain, it's time to review your income and expenses and make sure where you can make certain changes so that you are able to maintain that 30% of savings. So this is something important. Review it, and you can review your insurance plans as well. So we'll talk about insurance also in a bit. So whatever plans that you already have, you can just review it. Once in 2 to 3 years, you can just check how it is going. Revise your tax plan as well. So now currently we are in the month of Jan. 31st March would be the closing of the financial year. If you have not done your taxes, you have not planned your taxes, these are the last 3 months to plan your taxes for the financial year 22-23. So if you're someone who have not done it, please make sure that you do it as early as possible. If you are a salaried individual, then you have to give some investment proofs or declaration that you had given so that, proper TDS has been deducted on your salary. If you're not doing that, more TDS will be deducted in these months till March. For just to make sure that doesn't happen, make sure you declare it, do your investments, and then when the next assessment year comes, you can actually file your income tax return of this financial year in the month of July in 2023. So, but again, it's important to do that. Now, this is for the last year, but for the year 2023, when you're starting this year, from April, when new financial year will start, make sure from April month itself, you start planning your taxes. Whatever investments that you're supposed to do, maybe in ATC or maybe some health insurance that you need to take or NPS investment you need to make, you should be doing it at the start of the financial year, and you should be making a plan to do it in a phased manner throughout the year as well, so that it doesn't pinch your pocket at one go in the month of Feb or March. And also more TDS will be deducted. You'll file your returns and claim for a refund. So again, it's a lengthier process that you'll have to follow. So if you plan it in advance, you can actually make sure that all these things doesn't happen with you, right? So this is how you should be reviewing it: your performance of your investments, goals, income, expenses, insurance plans, and your tax plan as well. I hope it is clear till now. Any questions, anything that you would like to ask? Like I mentioned earlier, park it in the Q&A. I'll definitely take it up. Now, talking about how to rebalance your financial plan, again, this is important when we are talking about our investments, equity and debt. Some part I've invested into equity, some part I've invested into debt. There has to be some rebalancing which needs to be done. Now, currently, if you look at the current market situation, current market outlook, current global scenario that is happening, there need to be, some cautious step needs to be taken. You should not be overexposed to equity asset class right now. So if your major money is being parked into equity asset class, make sure that, some part of it you move to debt for your short-term to medium-term goals, which is just, coming this year or maybe in the next 1 or 2 years. That much money you should be parking it in debt. But the goals which are long-term, which is, let's say, your retirement goal or maybe child's education, which is 5 years or more, time is still there, those you can continue in equity market. So again, based on the market outlook, you can do certain rebalancing, take out money from your equity investment, park it in debt for some time. That is what strategic rebalancing is called, which needs to be done right now. Next is tactical rebalancing. Here I would say a finance expert is required, wherein, looking at the short-term volatility in the market, you can take certain decisions that, if it is expected that there will be some correction in the market, you can actually make sure that at that point of time you buy more into the equity markets. Also, if there's a goal which is coming up, which is very near, then at that point of time, it makes more sense that to take out money before any such corrections and, park it in the debt. It is very difficult to time the market. So that is why, just based on the overall economic outlook, overall market outlook, with the help of a finance expert, you should be taking these calls. Otherwise, for your long-term goals, you can just stay invested, be patient, and be consistent with your regular investments. Last is trigger-based rebalancing. Always have in mind that I would have an equity exposure of X percentage. Let's say based on your risk profile, you would have an equity exposure of 60%. Now, 60% of your money should be parked in equity share market. Now, if 60% is there, but because of the returns in the market, let's say instead of 60%, now once you're reviewing your portfolio, you find out that it's not 60%. Your allocation to equity has increased to 70%. So it is more than 60% what you had actually planned for. So that percentage should be there, that if my entire allocation changes by 10% plus or minus, I would do a rebalancing. So I'll take out money from the asset class where the money has grown more. So let's say from equity, and then I'll park it in debt for my short-term goals. So that is also something which is required. So when you're rebalancing, you can do a strategic rebalancing, you can do a tactical rebalancing, and you can also do a trigger-based rebalancing on your portfolio. This is something which you can do right now as well. It is suggested that just review your portfolio, check if there's some rebalancing required, and do it so that, for the entire financial year and for your upcoming goals, you are well prepared for in advance. Okay, I hope it is clear till now. Now, let me talk about certain investment options. I'll not discuss this in much detail. I would want that if anybody would like to know more about investment options specifically, you can ask it in Q&A. But yes, highly aggressive, if you are someone who, loves to take risk and is okay, and basically you understand risk, you understand that high risk, high return funda, that if you're taking high risk, there is a higher potential that you will be getting higher returns as well. But it comes with the risk of losing the capital as well. So if you're someone like that, then more investment options that you can look out for is direct equity share market, futures options, equity, small and mid cap mutual funds is what you can look forward to. Again, this is something which is for highly aggressive investor, but not just limited to it. You can always have a combination of this with a little, 10%, 20% exposure to debt as well, at least 10%. For aggressive investor, you can invest more of your money into large cap, mid cap, and small cap funds, sectoral funds, thematic funds. If you are a moderate investor, then you can invest into a balanced mutual funds, index funds, corporate funds. NPS, again, you can choose asset allocation as per your risk profile in NPS. Bonds, ULIPs, again in ULIPs also you can choose, more on a moderate side fund. If you're conservative or highly conservative, you have options like debt mutual funds, index funds, gilt funds, which is investment into government securities, bonds, fixed deposit. I would say fixed deposit makes sense only for emergency purposes. If you just want to park a small amount of money to meet your emergencies, you can park it in fixed deposit. Currently, fixed deposit would be giving you a higher returns because of increase in the interest rates. But for longer term perspective or slightly longer term perspective, you can park your money in liquid mutual funds as well for emergency needs. Government savings, endowment plans, ULIPs is what you can invest your money in. Highly conservative, again, then bank fixed deposit, even corporate fixed deposit, you can skip. Recurring deposits, public provident fund, which gives you 7.1%. Fixed income security. So Kanya Samriddhi Yojana, if you have a daughter, you can invest into SSY. It is giving 7.6% return currently. And certain fixed income plans, endowment plans also you can look out for. So depending upon your risk appetite, your investment horizon is what define that, what kind of an investment you should be doing, right? So these are certain options. You can decide based on this. Now, the last part of today's session, I would like to share with you 3 steps to ensure financial safety, as this is the start of the year 2023. Make sure you take it as a resolution that these are the 3 things that you make sure that it is done. It will define your financial health as well. So in order to understand whether you're financially healthy or not, it is important to check whether these 3 points, this checklist is done from your end or not. If not, it's highly crucial that you do it. So 3 steps to ensure financial safety. The first and the most important thing is to have an emergency fund in place. Now, looking at the current situation, also, towards the end of the last year, towards the end, we have seen companies laying off. So if in case some emergency comes up that a person loses their job, or some medical emergency comes up, or anything, some emergency which requires some cash outflow, you should be having certain money set aside just to address those emergencies. And that is why you should have an emergency fund in place. If you do not have an emergency fund right now, make sure that you start creating it on a month-to-month basis. And this year, you just create that emergency fund for yourself. Ideally, how much it should be? Somewhere around 6 to 8 months of your essential expenses you should be keeping aside to meet any emergency requirement. You can park this money into liquid mutual funds, liquid investment options, liquid mutual funds, fixed deposit, be bank fixed deposit or corporate fixed deposits, and liquid mutual funds, like I mentioned. So this is one first thing that you need to do. Second is life insurance. Can you all tell me how many of you have a life insurance? Just, some participation from your end. You can just type in yes or a no if you have a life insurance. Okay, Suraj has a term plan. That's great. Yes. That's great. Okay, so those who are saying yes, so this is something which I've already ticked from your checklist. So that's great for you. Anybody who doesn't have life insurance, it's really important, it's very crucial, it's very basic for your financial plan to have a life insurance. A person who is earning and you have people depending on your income, it's really crucial that you have a life insurance plan for you. In case of any unfortunate thing happens, it is for your family members, your loved ones whom you care for, that you're taking a life insurance plan. Like few of you mentioned about a term insurance, that's great. You should be having a term insurance. It's a pure risk cover. The vanilla term insurance plan that comes up is basically no maturity benefit. It is just the death benefit, which is part of term insurance. And that is the reason it is very cost effective. The premium would not be very high. It's somewhere around 10 to 12,000 for a 30-year-old for a 1 crore cover. So this is how much the premium would be on an annual basis. But how much term insurance one should have? Like few of you mentioned that you have a term plan, like someone mentioned 50 lakhs. Okay, most of you have not mentioned the amount, but like 3-4 of you are mentioning that, yes, you have a term plan. Rest, I'm not sure what kind of life insurance policy you have. Bhavish is saying only term plans. I never mix insurance and investment. That's great, Bhavish. This is something which you should be doing. You're already doing it. So congratulations on doing this correctly. Okay, so someone has a 1 crore term insurance as well. That's great. But ideally, how much should be your term insurance cover? I'll just give you some ideal figures just to have certain idea. So it's based on your age. So if someone is young, if someone is 30 years old, you should be having around 25 times of your annual income as a term cover. If you're in the middle age, around 40, then 15 times of your annual income. Or if you're someone who is closer to retirement, just 10 years away, then you can have 10 times of your annual income. So let's say if someone's annual income is 10 lakhs, then 1 crore is something which is required as a term plan. Now you check it for yourself whether you are underinsured or your ideal insurance cover you already have. If you already have it, well and good. If you have something less, then make sure that you get additional cover, and make sure that you're adequately insured with these numbers. You will get an idea. Right. So we were saying 3 things that you need to do. First is emergency fund. You should have 6 to 8 months of your expenses. Second is a term insurance cover. One needs to have around 25, 15 or 10 times depending upon your age. Now, the last one is health insurance. Now, how many of you have a health insurance? Can you tell me that in the chat? How many of you have a health insurance? Okay. Yes. No, that's okay. Yes. 50 lakhs. Okay. Both personal and corporate. Okay. Yes. Anybody who doesn't have a health insurance? 5 lakhs. Okay. Yes. Okay. Few of you are mentioning yes. Other, I just assume that if you're not mentioning, you will not have it. Yes, you have corporate insurance. Okay, we'll discuss that as well. If your company is giving you a cover, 5 lakhs personal, 5 lakh corporates, their personal health insurance needed. Yes, Nagesh, if you have a corporate health insurance plan, still a personal health insurance is needed. Now, why it is, let's understand that when we talk about a health insurance plan, it is required when you need it the most. Now, let's take an example, when the pandemic hit us in the year 2020. What happened is many people lost their job. Now, with their job, they also lost their health insurance cover. And because of that, when they were being hospitalized or any family members were being hospitalized, they didn't have job, first of all. Second, they didn't have a health insurance cover. So it's an added financial burden. So if you just have a health insurance plan, which your company is giving it to you, which is a great benefit, no doubt, but in the time of emergencies, or if you lose your job, or if you maybe when you change your job and maybe the other employer is not providing this benefit, then it will be difficult. Also, once you retire, your health insurance cover with the company will cease then and there. Sometimes it also happens when you're changing the job, maybe, or if the layoff happens. And currently also we are seeing the the layoffs that has happened. So at that point of time, it can happen that maybe in one company where you were working, you were getting more benefits, your parents were also covered, your family was covered. Maybe the other company which you join later on, they're just covering you, they're not covering your parents, they're not covering your spouse. So it's always a risk of not having adequate insurance. So make sure that, apart from whatever your company is giving, you should have a personal health insurance cover for yourself, covering not only yourself, but all your members of your family. You should have an adequate cover, somewhere in the range of at least, on a minimum side, 10 to 15 lakhs on a minimum side one should have. Looking at the higher cost, medical cost, we see that 10%, medical inflation. You can have 15 to 20 lakhs of cover, but don't go below this figure. Looking at the current medical cost. And when we talk about health insurance, there are a couple of things that you should be keeping in mind while actually selecting a health insurance plan for yourself. This includes, you check for co-payments. Now, co-payments is something, sometimes if I give an example, a co-payment clause of 20% will say that whenever a claim comes, 20% of the money the insured will have to pay, and only the remaining money the insurance company will pay. So 100% company will not pay because you have taken a co-payment option of 20%. Now what happens is, because you are also paying certain part of it, the premium will be lower, but it is not an ideal situation to be in, because whenever you are in emergency, whenever there's a hospitalization, you need to pay money, and then suddenly 20 or 25% based on the clause, that money you have to pay it from your own pockets. So make sure there's no hidden clause of co-payments, or maybe you are not aware that there was a co-payment clause in your health insurance policy. So whenever you're going for health insurance, make sure that you check for that. You can check capping on room rents. So, what kind of a room that you are eligible for, whether you are okay with it, that, based on your standard of living. If not, then make sure that you go for plans which doesn't have any capping on room rents. Sometimes there are certain sublimits on, particular critical illnesses, some diseases, pre and post hospitalization care. Some go for the plans which has a low waiting period, maybe 2 years or 3 years and not 4-5 years. Coverage of daycare treatments, the list should be exhaustive. Go through a list of what is included, what is excluded. You can ask for restoration benefits. There are many companies which are offering restoration benefits. So opt for those kinds of plans. No claim bonuses, the maximum no claim bonus that you're getting in your plan, the better it is. So these are certain things that you should be keeping in mind while selecting a health insurance plan for yourself, so that you're making a good decision for yourself, ensuring not only yourself, but your family members, so that in case of any medical emergency, the needs are well taken care of, right? So this is about your health insurance. So 3 things: your emergency fund, your life insurance, health insurance. This is a very basic crux of creating your entire financial plan. If I summarize whatever we discussed in today's session, always remember your financial goals and investment time frame. Your SMART goal is what you need to set for yourself. Invest, and you start investing early and stay invested for long-term. Consistency, patience is required. Diversification is required. Invest across different asset classes and be aligned with your financial goals. And the last one, review your financial goals periodically. Now, when you talk about goals, you should be reviewing it, at least once in 2 years. But your investments, specifically your market-linked investments, you should be doing on a quarterly basis. So every quarter, just check if it is, in the right direction. Then you can have a, 6 months review, and then you can have an annual review for your investments. For goals and all, it will not change that drastically, but every year you can just make sure that if there's anything additions or subtractions, you can do that part as well. So from my end, this is it. And I think the journey of 1,000 miles began with 1 step. So definitely for all of you, I would wish that, you just take that 1 step for yourself in this financial journey. Be more closer to your financial goals. And this is what is required. At any point of time, if you need any assistance, any help from our team of tax experts and finance experts, feel free to get in touch with us. You can just scan the QR code and just book a 15 minutes free consultation with our experts. If you have any question which is personal in nature, you do not want to discuss in this platform, you can email your question to us at corp@fintu.in. You can also, give your any questions, queries that you would like to ask. You can reach out to us on the number given on the screen. And yes, and we are providing a 15-minute free consultation. So if you would want that, you can ask for that as well. So with this, I would now like to take up questions. So I can see there are many questions parked in the Q&A. So I'll take it up there. So if once okay, for making a corpus. Okay, I think many people have used Q&A box as chat. Just close. If you still have any questions, you can park your questions. Okay, so Sandeep is asking, if inflation is 7% or more, how much return should we expect, given returns would be taxable as well as per the different investments? Yes, so what you, Sandeep, you have to make sure that, yes, if you're considering an average an inflation of 7%, your investment should be giving you higher than that. Now, let's say 12% you are generating through, equity mutual funds, or 15% you are generating. So post, you adjust the inflation, your real rate of return will still be positive. Understand, when we talk about their taxation rules, it is different for different investment options. For equity, for long term, the taxation is 10% after making that 1 lakh of gain as exempt. So 10%, but for debt, it could be 20% with indexation benefit after 3 years. So it will differ from investment to investment, but you can always calculate it depending upon how much amount you're investing where and what is the return that you're expecting, and then the taxation of that. So to beat inflation of 7%, 12%, 15% till 18%, considering your risk profile, that much return you can, aim for overall on a portfolio, which will also have certain investments like debt investments, which will be giving you, 8% or 7% return also, because a mix is required. Mutual funds, PPF, okay. I want to invest, I want to start an SIP, but I don't have a Demat account. How do you KYC? See, for execution, anything, if you have any query, feel free to get in touch with our team. We will help you out in setting up your SIPs and everything. So Payal, you can get in touch with us for the process. And Demat account is not required for that. Even if you do not have a Demat account, you can start making SIPs. Is it possible that a very aggressive investor can lose money? Yes, Dinesh, see, basically when we talk about aggressive investors, if you're taking more risk, with the possibility or with the potential of earning high returns, there's also a possibility that you lose your money. So there has to be, a balance. That is why, instead of saying 100% into equity or risky asset, that 10-20% exposure to debt is also required. And it again depends from individual to individual, because, there is it's more like, a person is looking at a higher return and he's ready to take up that risk to achieve that returns. If you are okay with lower returns, you are basically maybe a conservative. I'm just taking an example, but a conservative investor will think like, I would not like to lose my money. Even if the returns are low, I'm okay with it. So again, when you're investing your money into the market, there's no guarantee as such, but yes, based on the past returns, based on the expertise, you can always, understand, how you can actually invest your money. You can get in touch with a finance expert and understand how that entire plan you can create for yourself. It's always better to have a plan than not having any plan. And then yes, reviews and, rebalancing and everything is required so that you stay on track. That is how it will be done. What's the easiest way of making 1.5 crores in 10 years? So Rakesh, see, basically the easiest way will be to increase your savings or investment amount. So the maximum amount that you will be investing, it will help you out. Also, because you're talking about 10 years, you should be making the investment into equity. If you're someone who is who is a beginner or is not investing into equity market so far, you can, opt for mutual funds route. You can create your portfolio into mutual funds by investing into large cap, mid cap, small cap under, different percentages depending upon your risk profile for 10 years. And try to save, as much as possible, invest as much as possible for these 10 years, so that you can create this 1.5 crores. It will not be very difficult. Can we have this session on YouTube as joined late? I think you will get the recording. You can just check that. Where to invest my 7.5 lakhs at one time? See, Nilesh, it depends. At one time, when do you need this money? So that also depends. So is it a short-term investment? Is it a medium-term investment? Is it a long-term investment? Also looking at the current market, if it is a long-term investment you're asking for, okay, 10 years investment you're asking. So if you have 10 years and you have 7.5 lakh that you would like to invest right now, I would suggest don't invest the entire 7.5 lakhs at one go. Looking at how the markets are volatile, make sure that you just enter one part of it. And looking at the markets, whenever there's a correction, you then enter again. Or if you want to make things more simpler, you can just park your money into a liquid fund and then start an STP into an equity fund. So STP is basically systematic transfer plan. It's, it's similar to, how SIP is. So SIP is some money is going from your bank account to mutual fund every month. STP is from one fund to another fund. So you can park it in liquid and give an instruction that, X amount every month, should be going from this account to that account. So maybe in, next 6-7 months, the entire amount is shifted to equity instead of putting it at one go. Or you can just break it into 3-4 parts and looking at the market condition, just have a discussion with a finance expert, when is the right time to actually put that money. In phased manner, you can take exposure to equity markets. So if you have lump sum with you. I hope this is clear. And I just hope for everyone that the session was useful and informative for all of you. I just hope that, whatever we have discussed in today's session, you implement it and try to have your own financial plan, create your own SMART goals, define your goals, create a strategy, have an asset allocation, and start planning for your year ahead. So I wish you all a very happy new year, and may this year be financially very successful for all of you. So thank you so much for being there till the end of the session. And if you have any other question, feel free to let us know on email ID or phone number. You can also book a 15-minute free consultation, like I said. It will help you out to understand, where you stand right now. So you can take that opportunity as well. And thank you so much, everyone. I'm just glad that the session was useful for all of you. Thank you so much for all your comments. So thank you so much. I'm glad, and have a nice day ahead, everyone. Thanks again.